Right, good morning. It's Friday, it's 11 a.m. So welcome to this week's weekly show. First of all, as usual, I'm going to run through the sort of key news events from this week. And then we've got Nicholas Windling of JP Morgan Japanese as this week's special guest. But sort of first, the news. So three things I just wanted to quickly talk about, because it's been quite a slow week in investment trust land. There's been a sort of an update on the liquidation process for Menhaden resource efficiency. There's been quite a bit going on with Gore Street Energy storage, and then we've also had some news from investment companies on sort of how we'll be able to raise money in the future and the sort of need for prospectus, which is also quite exciting. So first of all, with Menhaden resource efficiency, for sort of those that are following this or sort of shareholders in this, obviously this is going through a liquidation process and shares have now been suspended. But a sort of new update was published this week, basically sort of holdings into the TCI Real Estate Partners funds. I think Fund 3 and Fund 4 have been sold, and they've raised 9.5 million of cash. There's sort of two further unlisted investments that they've sort of got in the pipeline, and they've got sort of talking to respective parties about those, and they're also aiming to have the sort of sales of those completed by the sort of end of the month. That's what they're saying. Because of this, there was a third distribution of shareholders planned, but that's now going to be postponed, ideally until after the sales are achieved. So far, Menhaden has paid out sort of £1.02 a share, but it's expecting it will be at least £1.60. So obviously a good chunk to go. They said at this stage there will be a further update on this at least by the 8th of August, and they'll sort of ideally be saying when that next distribution case next thing. So Gore Street Energy Storage, it's been quite a sort of exciting week for Gore Street. So on Monday, this was anticipated, but it's sort of some of the last of its US investment tax credits. For those that sort of followed this, we have a sort of different system here where by and large subsidies are sort of paid over, a 20-year period, fits, etc. In the US, the way it works is you basically get these big upfront tax credits for creating these projects. And what you do is you actually sell them to somebody else who can use the tax credit because invariably these projects are. And that's how you get the sort of benefit. Now, there was obviously this outstanding tax credit for the Big Rock project in California. They've now sold this. They're going to get half the money shortly, further quarter in the autumn, and the rest by the end of the year. So that's some pretty good news. They basically send sort of first tranche, the half that's going to come very, very shortly, is going to be used to reduce sort of Big Rock's borrowing. So basically from about $90 million to sort of 60 million. And there's also going to sort of fund reserves to cover sort of further build out costs. But sort of overall, it's going to lower Gore Street's gearing and obviously the associated borrowing costs because they're tiered. But long been flagged that there's going to be, assuming that all of this completed in the way that they planned, a 3p sort of special dividend. And that's going to come later this year. Now, obviously, that happened on Tuesday. Sort of fast forward to Wednesday, and RM funds, manager of RM Infrastructure Income and the like, have requisitioned Gore Street. There's a written letter to shareholders, and you can find that on their website. But the sort of kind of things they're highlighting is there's a big disconnect between the share price and NAV, 37%. I mean, that's not. They argue that it's the sort of worst performing infrastructure fund. I think that's dubious, and there's obviously been a lot of challenges. We can talk about that in a second. That obviously the renewable energy funds and in particular the battery storage funds have changed or sort of faced. But anyway, that's the sort of case they're making. They're also arguing that fee structure based solely on NAV problematic. Well, we know that, but we also know they've changed that since. And they're arguing that the sort of pressure they've applied, I think the rest of 5% holding, has brought about these material forms. They're now saying, obviously, there are sort of fee changes coming through. We know they've removed the performance fee already. But are claiming that and claiming that the move to a sort of combination of NAV and market cap and the movement of sort of poison pill provisions are as a result of their pressure. They're still saying there are a number of governance failing. They're sort of saying obviously this was launched in 2018. A majority of the board has been there since the beginning, and they think it's due a refresh. Obviously, Gore Street's already put in place a strategic review. We already know that. but they're saying that they want to appoint directors with experience in conducting strategic reviews and in infrastructure platforms specifically. They said that they're actually trying to have these conversations privately, but had not gone anywhere. I mean, looking at this yesterday, often with these sorts of funds, you will see, directors that have got experience, say, working power generation in utilities, and that there still appears to be a dearth of that experience, which is perhaps a little bit surprising. So maybe they've got a point there. They've argued there's been a sort of lack of transparency around share engagement, buybacks. They say the buybacks have repeatedly been called for, and these haven't been implemented. We can come back to that in a bit. But they're also arguing that their strategy of sort of communication on asset allocation, dividend and policy, and strategic options remains opaque. As I was saying before, the challenges by the renewable energy funds, what they're facing, are well documented. All of these things deteriorated as interest rates went up. And then obviously as the economy faltered, you had a lot of negative sentiment towards green initiatives anyway, and that sort of pressed these funds further, and you saw discounts gap out even wider. But the sort of 3 battery storage funds were hit particularly hard, and that's because National Grid, ESO, introduced this new software that balanced the grid. It was supposed to make better provision of these battery storage, of these best assets, and it wasn't able to do that. And so the best asset funds, they missed out on revenues. They said the sharp dividend cuts, which pushed their sort of discounts even further. Our view on this is the sort of discounts renewable energy funds and the best assets in particular have been significantly overdone. I mean, if you look at the way a lot of the NAVs have held up and you look at the sort of inflation linkages and the sort of solidity of cash flows, a lot of these really don't make sense. And I think, the sort of bid for permanent energy income from Foresight, where also we competed against Dragons, really illustrated that. And in the end, Foresight ended up sort of paying a premium NAV to secure those assets. And fundamentally, progress has been made on the sort of issues that are plaguing these. And I think, in comparison, that sort of progress not only underpinned the sort of Harmony Energy bid, but also allowed, the other sort of fund of the 3, Gresham House Energy Storage, to set out a clear 3-year plan with the expectation it will be able to reinstate covered dividends later this year. I think, this might be part of the issue. In our sort of opinion, best funds are operating long-term sort of structural growth areas. More and more generation moves to renewables. These are inherently intermittent in nature. Whether it's BESS or other solutions, basically you need more energy storage capacity to deal with this. And a lot of these sort of challenges, they are sort of teething problems as this new technology is incorporated into the grid, and the grid has to be redesigned to allow for them. It's worth sort of saying that, Gore Street has already initiated a strategic review and it's already brought its fees down. But I think if you look at what some of the other funds done, it doesn't appear to be quite as proactive. And I think, that is really where our end is coming from. Now, this all looked fairly straightforward. Obviously, Gore Street had its results out yesterday. We would have said prior to these, RM was going to have to make a sort of stronger case as to really why it needed a structured board, why they've failed at this stage. But then, Gore Street's results came out. They announced a significant dividend cut. And I think sort of beleaguered shareholders will actually be quite open to sort of shake up after the latest news. But let's have a look at that. Okay. Actually, here, if you sort of look at the chart of the share price and everything, you can see basically how the NAV's held up fairly well. As I say, it's trading above par, etc. Look at the sort of share price. Obviously, there's a hefty discount there, but you can see as of the beginning of this year, it's been tracking up again, and this reflects the progress that's been made, and obviously the read across from the Harmony Energy income bid. Now, so this is a sort of chart taken from the LSE that just shows what happened yesterday. Clearly, the results were not well received by the market. This is sort of chucked down quite a lot, but actually, it's come up quite a bit significantly. Certainly after, I think, the analyst briefing that was held yesterday morning, there was a more positive view about sort of where this was going. Now, let's just quickly talk about the results. Obviously, Gore Street pays quarterly dividends, and there has been a cut in the quarterly dividend rate from 1 pence to 0.75 pence, which implies a minimum dividend in the year of 3 pence. As I said earlier, the last of the big rocks tax credit money won't arrive until November. So there's obviously going to be a lag in paying this 3p special, but obviously they still expect that happening this year. Going forward, it's going to distribute all of its free cash flow as dividends each year. And the way this is going to work is it will top up the fourth quarter based on the sort of cash flow generated. When we sort of look at FY26, you're going to see the portfolio should benefit from around 9 months of revenue from Big Rock. That's obviously not in FY25 results. Average capacity last year was sort of 408 megawatts. With everything operational, that's going to rise to about 753.4 or 924.1 as they sort of introduce some of these sort of longer than 1 hour duration assets. There's also some indication that what's going to happen for FY27. It appears that actually they've already moved and putting in, the sort of building blocks in place to do upgrades to Ferrymuir and the sort of Stony assets. Once again, it's going to shift these from 1 hour duration to 2 hour duration assets. The interesting thing about that is actually they have quite a short payback period. You can earn quite a lot more money having this sort of second hour or 2 hour versus 1 hour duration assets, which is why it's quite attractive. They're also potentially looking to upgrade NW2. Process takes about 12 months, as I said, short payback period. In FY25, the average revenue per megawatt hour was £9.85, and really a big factor in this was a sort of lower, cooler, or sort of summer temperatures in Texas, which meant there was less demand for air conditioning and lower power fluctuations, as a result of less demand for the batteries. Now, Gore Street estimates that its revenue stays around the sort of £10 per megawatt hour level, then free cash flow per share could be about 3.9 pence for FY26. So, there's a potential if that happens for another 9.9 pence to cover that final dividend, but that could rise to 4.5 pence once the sort of augmentations for Ferrymuir and Stony are complete. However, they also say were, sort of revenue levels to recover to the previous peaks of about £15 per megawatt hour, then this would be sort of much heftier. You'd be talking about 8.76 pence in FY26. Once again, 9.7 or 9.67 pence on the back of the augmentation, assuming obviously that will go ahead as planned. Interesting thing, because obviously there's been a lot of talk about, with this money coming in, what were the plans? Could it have been, put to share buybacks, etc. Something came out of the briefing yesterday that the sort of decision to proceed with the augmentations was not weighed against the alternative of paying down debt and not against the other alternative of buying back shares. It just appeared they weren't on the table. I think some investors probably won't be too happy about that. Okay, final thing I wanted to talk about was this announced by the FCA this week. It has said that London-listed closed-end funds could be allowed to raise up to 100% of their existing share capital, so basically doubling in size without issuing prospectus. And the idea is if they're doing what they're doing already, it's just capital growth. That really is sort of beneficial for existing holders. So why shouldn't they be allowed to do it? This is really good news for the sector, assuming that it's come past. Obviously, these prospectuses often they're regurgitating the last set of results and just updating for that. They're costly to produce, and obviously this sector naturally benefits from additional scale. FCA estimates it could save about 40 million a year. Investment companies will still be able to issue shares without issuing prospectus, provided once the money is raised, is invested in line with their existing policy. There are some other measures that were announced at the same time. Should actually make it easy for companies to issue corporate bonds to private investors, as we sign new rules for sort of public offer platforms and crowdfunding websites should help smaller companies raise growth capital about 5 billion, so maybe it helps that sector as well. Right, moving on. Obviously, this is the disclaimer, important bit. Please take a moment to read that. If you can't, obviously, it's going to be on the video later.